You know, we're always told that dollar cost averaging is the safest, smartest way to invest. But what if one of the most common pieces of financial advice out there is actually costing you money? Well, today we're going to see what the data really says. Seriously, they've called this the $3 trillion question that nobody asks. And that's because every single year, millions of us make a decision about this very strategy, moving trillions of dollars around the market, often without ever seeing the full picture. So what is it that we're all missing? Okay, to make this real, let's talk about Sarah. She's 28 and she just inherited $50,000. Now she's facing that classic dilemma. Does she invest all of it in one go? Lump sum investing? Or does she follow all that popular advice and just spread it out over time? Sarah, like a lot of us would, chose what she thought was the safe route. She decided to dollar cost average, putting in a little over $4,000 every single month for a year. It felt smart, it felt controlled. But that decision, it had a really surprising and pretty costly outcome. So get this, by the end of that year, her safe strategy had cost her around $6,800 in potential gains compared to if she just put the entire 50 grand in on day one. And here's the kicker. This was in a falling market. How is that even possible? How can the supposedly less risky strategy end up doing worse? And believe me, Sarah's story isn't some weird fluke. A huge study from Vanguard looked at decades of market history all across the globe. And what they found was that investing a lump sum beats dollar cost averaging about 2/3 of the time. Just let that sink in. 68% of the time, the math says you're better off going all in from the start. All right, so to really understand this disconnect, we have to push past the popular wisdom for a second and just get into the simple, kind of unavoidable math of how markets actually behave. So first off, what is dollar cost averaging really? Well, the idea is simple, and honestly, it's super appealing. You invest a fixed amount of money on a regular schedule, let's say $500 a month, and you automatically end up buying more shares when the price is low and fewer shares when the price is high. It feels like you're being clever, buying the dips without having to be some kind of market genius. But here is the catch, and it's a big one. When you choose to dollar cost average, you're making an implicit bet. By keeping cash on the sidelines, you're essentially betting that the market is going to go down in the near future so you can buy in cheaper later. The problem with that bet? History shows us that markets go up way more often than they go down. So by waiting, you're statistically much more likely to miss out on gains than you are to avoid losses. And we can actually put a number on the cost of that delay. On average, in the US market, choosing to DCA a lump sum over 12 months has historically cost you about 2.3% in returns. That 2.3%, that's the opportunity cost. It's the price you pay for not having all your money working for you from day one. And this, right here, brings us to the absolute core of this whole thing. If the math is so clearly stacked against it, why on earth is dollar cost averaging one of the most popular investment strategies in the world? Well, the answer has a lot less to do with spreadsheets and way more to do with our own psychology. So if DCA isn't really solving for the best possible returns, what is it for? Turns out it's a solution to an emotional problem, not a financial one. You see, groundbreaking research from psychologists Kahneman and Tversky found something incredible about our brains. We feel the pain of a loss about 2.5 times more powerfully than the pleasure of an equivalent gain. Think about it. Losing $100 just hurts way more than finding $100 feels good. Our brains are hardwired to avoid regret at all costs. And this gets to the absolute heart of it. DCA isn't really designed to reduce mathematical risk, that is, the actual ups and downs of your portfolio. No, it's designed to reduce emotional risk, that gut-wrenching, sick feeling of regret you'd have if you invested your whole inheritance right before a massive market crash. And the data totally backs this up. A Morningstar study found that investors who used DCA were way more satisfied with their decisions, even when they knew their financial returns were lower. So, in effect, they were paying a premium, that 2.3% we talked about earlier, for peace of mind. They were basically buying psychological insurance against regret. Okay, this all builds up to what might be the single most important, most misunderstood point in this entire debate. See, when people argue about DCA, they are almost always talking about two completely different things without even realizing it. First, you've got what we can call involuntary DCA. This is what most of us do every day. It's when you invest a piece of your regular paycheck into your 401k or another account. You're not choosing to spread out a big pile of cash, you're just investing money as you get it. This isn't really a strategy to be debated, it's just the most logical way to deploy your capital. Then there's voluntary DCA. This is Sarah's situation. This is when you have a lump sum of cash sitting there from an inheritance, a bonus, selling a house, and you make a conscious choice to feed it into the market piece by piece over time. This is the specific scenario where all that research shows that lump sum investing is mathematically the better option. Mixing these two up is what leads to so much confusing advice. So, now that we've made that critical distinction, we can build a much more intelligent framework for making the right decision for you. It's not about math versus emotion. It's about understanding which situation you're actually in and what you're truly trying to optimize for. Because here's the absolute bottom line, folks. A mathematically perfect strategy is completely useless if it causes you so much stress and anxiety that you panic and sell everything at the absolute worst possible moment. The best strategy is always the one that keeps you in the game. So how do you decide what's right for you? Let's just break it down. You should probably consider a lump sum if you've got a high tolerance for risk, you've got a long time horizon, like 10 plus years, and your main goal is just to maximize your potential returns. But on the other hand, you should seriously consider DCA if you're anxious about big losses, if this is your first time investing a large amount of money, or if your primary goal is simply to build the habit and make sure you stay invested without freaking out. Ultimately, it all just comes down to this one question. Are you trying to optimize for pure returns, or are you trying to optimize for simply staying in the game? The best financial decision isn't always found on a spreadsheet. Sometimes it's found by knowing yourself. Thanks for joining us for this explainer.